However, let's not forget China's long-term strategy. It has been steadily accumulating gold reserves and positioning itself as a third global hub for gold trading. Beijing views a strong gold price as a way to support the yuan and bolster monetary credibility. Realistically, U.S.-China trade tensions are unlikely to be resolved anytime soon. I saw President Trump announced that the tariffs are going to be 155% if no deal is done with China prior to November 1st. Ironically, one major bank that recently called for a 20% gold allocation also suggested this week that gold might be in the bubble. In the OTC market, we've seen roughly 24 million ounces of silver shipped out of CME warehouses in the past 2 weeks. Some liquidity is returning to London, but the market still faces a critical shortage, likely needing another 100 to 150 million ounces to normalize conditions.
China continues to expand its gold reserves and aims to establish itself as a major global gold trading hub. Analysts see gold potentially reaching higher within 12 to 24 months if central bank buying, especially by China, continues and the US dollar weakens. Meanwhile, China's push to store foreign gold reserves in Shanghai could shift the global gold hub from London to China, boosting the yuan's influence and challenging dollar dominance. Meanwhile, China trade tensions remain unresolved, with President Trump threatening tariffs of up to 155% if no deal is reached by November 1st. Morgan Stanley, while advising a 20% gold allocation, also warned that gold may be entering bubble territory. In silver, around 24 million ounces have recently left CME warehouses, signaling tight supply despite some improvement in London liquidity. The move of large silver volumes into London suggests the tightness is easing, but the market is still very sensitive. Mario Innecco is a British-based economist, former bond trader, and precious metals analyst, points out that recent corrections in gold and silver have sparked fear, but such pullbacks are normal in a bull market. China continues to accumulate gold and aims to become a global trading hub, using a strong gold price to reinforce the yuan's credibility. Meanwhile, the U.S. economy appears overstated, with growth heavily reliant on AI and private credit and inflation still high. The markets are always shifting. Don't fall behind. To keep ahead of the curve, subscribe and like this video. Please leave your comments in the space provided below. We would be very grateful to hear from you.
There's been a lot of scaremongering the last few days because gold and silver have corrected, and which is normal. As I said, the higher we go, the more turbulent it's going to get. And that's why a bull market is called the bull market, because yes, it gets really turbulent, it gets really choppy, and if you don't hold on to the bull, you fall off, i.e., you get out of that market, you get rid of your gold and silver. And by that, I don't mean trading gold and silver. I mean your insurance against this currency debasement, which is holding the physical stuff, right? And in the UK, I recommend coins of the realm, gold and silver, because there's no capital gains tax. But yeah, there's been a lot of scaremongering how gold is useless and everything, and I'm not going to name names. I'm going to ignore all the hate and stuff and just focus on the truth about gold. There's a note saying that, and I forgot the person's name, but gold is the currency of kings, silver is the currency of gentlemen, and fiat money, or what we have today, is the currency of slaves. So that's what it's all about. I'm not saying gold is an investment, even though it's acting in terms of returns as an investment. No, gold is insurance against inflation and currency debasement, and it will continue to be. It's also insurance versus financial calamity, like bank runs, bank failures, and all those kinds of things, and geopolitical mayhem. And I don't think things are getting better. And in the U.S., I just looked at the debt clock. We're fast approaching 38 trillion. Yes, the debt to GDP seems to have come down a little bit from 123 to 120 and a half. But I think that's all based on the AI bubble. The GDP in the second quarter, half of GDP growth was all AI, AI data centers. And I think, there's too much emphasis being put on AI, and the US economy is doing a lot better than all the other ones because there's a massive infusion of capital, especially from the shadow banking sector, like from private credit, private equity, and we know that there's trouble there. I have spoken about it recently. So I'm not saying the stock market is going to collapse, that the AI bubble is going to burst, but that's something to keep in mind. So I don't think the U.S. economy is as healthy as we're told. I think inflation in the U.S. is pretty bad too. It's a little lower than in the U.K., but not that much better. So back to gold and silver. Let's go through what this former bullion banker, Robert Gotautle, said about what's going on, especially yesterday with gold and silver. And he's got a very long track record since the early 80s in the precious metals. And he worked for Citibank, he worked for HSBC, Bear Stearns, and JP Morgan. He's retired now. So I think he's probably saying things he wouldn't say maybe if he was still working at JP Morgan, even though I can't really vouch for what he thinks. But I think he's given a pretty honest summary of what's going on. So I'll go through it. I follow him on LinkedIn. Maybe I might even get him to do an interview, which is weird, interviewing a bullion banker. Anyway, major correction in precious metals today. That was October 21st. I think it's a date that people will remember. Gold and silver saw a sharp sell-off today, with gold down 5%, silver down 7%. I know I've said it before, but it bears repeating. Nothing moves straight up. The higher prices climb, the larger and more violent the pullbacks tend to be. What possibly triggered the sell-off now? Number one, optimism on U.S.-China trade talks. He says yesterday President Trump mentioned he expects a good outcome with China at the end of the month. When both sides meet, markets interpreted this as a sign of easing tensions and therefore less need for safe haven assets like gold. However, let's not forget China's long-term strategy. It has been steadily accumulating gold reserves and positioning itself as a third global hub for gold trading. Beijing views a strong gold price as a way to support the yuan and bolster monetary credibility.
Mario Innecco here discusses that despite the drop, gold is still up 57% and silver 68% year-to-date. Silver's decline reflects its strong earlier gains and lack of central bank support, while physical shortages persist in the OTC market amid years of structural deficit. Mario views this rally not as a bubble, but as part of a long-term shift toward gold and silver as strategic reserve assets amid the gradual erosion of fiat currency credibility. Let's get into the details of the interview for further insight.
Realistically, U.S.-China trade tensions are unlikely to be resolved anytime soon. I saw President Trump announced that the tariffs are going to be 155% if no deal is done with China prior to November 1st. Second reason Mr. Gotautle gives, crowded longs and momentum selling. Over the past several weeks, numerous banks and analysts have been advocating for adding gold to portfolios. That narrative, combined with gold's breakout to record highs, has attracted a wave of new speculative longs. Gold has become a momentum trade, and with momentum trade comes fragility. I agree with him. It's become a speculator's game. And that's not what I've been recommending and talking about on this channel. I've been talking about having gold as insurance, physical gold, not leveraging, right? So if you're trading, yeah, that's a different story. So, and he continues, when prices faltered, weak longs, CTA trend following funds, commodity trading, their commodity trading funds, like futures funds, and opportunistic hedge funds going short, all rushed for the exits at once, triggering an avalanche of selling. Ironically, one major bank that recently called for a 20% gold allocation also suggested this week that gold might be in the bubble. That was Morgan Stanley, by the way. Let's continue. Context and perspective. That's Mr. Gottlieb. Even after today's drop, gold remains up about 57% and silver up 68% year to date. Still an exceptional rally. Silver's steep decline today reflects the fact that it has outperformed gold this year and lacks the deep-pocketed central bank sponsorship that gold enjoys. In the OTC market, we've seen roughly 24 million ounces of silver shipped out of CME warehouses in the past 2 weeks. Some liquidity is returning to London, but the market still faces a critical shortage, likely needing another 100 to 150 million ounces to normalize conditions. Maybe this is something Mr. Gottlieb probably doesn't agree with me. He thinks this situation is normal in the LBMA. I think it just goes to show how much of a fraudulent market the OTC market is. They don't really trade real gold. They trade paper, and that's why they have this shortage, because they sold too much paper and there's not enough physical. And I think that's a fraud. It's like you being a car salesperson and selling cars that you don't have and making people wait. That is wrong. Anyway, let's continue. Keep in mind, silver has been in structural deficit for 5 consecutive years. Yeah, it's a good idea to sell it short, the silver that you don't have when that's happening, right? Anyway, supported by both industrial demand and its safe haven appeal. Long-term outlook for gold and silver from Mr. Gottlieb. The World Gold Council Central Bank Survey shows that 75% of central banks plan to increase reserves over the next 5 years. Nothing has changed in that fundamental story. Central banks will continue to diversify away from the US dollar and other fiat currencies. This rally is unlike any other. So yeah, it's not a bubble, people. Controlled demolition of the fiat currency system. That's what it is. And that's why it looks like it's a bubble for gold and silver, but it isn't. The rally, China buys when the dollar is strong as a hedge against its currency, while Western central banks step in when the dollar weakens. That dynamic is restoring how the world views gold, not just as a trade. Yeah, it's not just a trade, but as a strategic reserve asset. And I would say central banks don't care about the price, even though they're probably quite happy. We've seen a bit of a correction in the last few days. It's always better to buy something cheaper. But I think if they're looking to buy on this dip, they got to do it quickly, because we're going to look at where the markets are this morning and at a few things as well. We just have to wait for the dust to settle, that's what he says, and clear out the weak longs for this rally to continue.
How does China's growing role in global gold trading and reserve accumulation influence the long-term outlook for gold and the yuan? Mario Innecco argues the current rally isn't a bubble but a shift toward sound money. Do you agree that gold and silver are reclaiming their role as strategic reserve assets? If you appreciate this video, please hit the bell button for timely updates, subscribe to the channel, and like the video. Also, leave a remark with your ideas. We value your presence and thank you for your support.